I'll give you another little idea on some of the other questions you can ask. You want to know the answers to most of them, but you don't necessarily have to ask each one of them. Understand that some of the questions may or may not be as important, but it may give you clues about how good this is as an investment.
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is the Trinity of freedom: time, financial, and geography freedom. I'm your host, Micy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I am on a mission to help hundreds of thousands of people like me to do the same.
Hi there, welcome to another episode of the American Dream Builder and Investor podcast. Today, we're going to continue to dive into due diligence in real estate syndications as a passive investor. Today, we'll focus on the market and the property. Our last episode focused on the sponsor, the jockey, which is really important. Think about the horse race. You want to bet on the jockey as much as you bet on the horse itself. But the next piece is also important. It's the market. So when I say the market, I want to split into two pieces of the market. One is the economic cycle market, business market. The other part is actually the geographic market. I think when you're investing, it's important to understand where your market is at in the overall cycle of the economy. So in the real estate market or in the business market, we typically have a few phases. And depending on the book you follow, there's different phases, but some of the typical phases include recovery, expansion, hypersupply, and recession. Recovery is more of a seller's market where we'll have decreasing vacancies, low construction rate, low rental growth rate, and moderate absorption, meaning when units come on, it gets absorbed into the market somewhat quickly because the demand is increasing. So market is going up. So it's slowly becoming more of a seller's market. And while it continues to move up, it moves into this expansion phase where it's continuously even faster pace decrease in vacancies and building more, and also rental growth are higher. For example, like what we saw in the 2020-2022 period, right? We had all this COVID money and high inflation that we're going through, and lower interest rate at the earlier stages of our COVID economy. And then the tipping point comes where there's going to start to have more of a hyper supply. It could just be like 2008, 2009, where we actually built so much more than what we need. So things started to go down in prices from a hyper supply standpoint, and also from due to the credit ratings that we were having. And also, we know that the reason that 2008, 2009 recession happened was because of the falling house prices. And that was mostly stemmed from cheap credit and lax lending standards. And also, it coincided with a rising supply of new built houses. So all that together introduced a hyper supply of market. What we're seeing right now in post-COVID world in 2023 is a different problem, but it's in certain markets, we're seeing this a lot more than others of hyper supply. Not necessarily because there is a lot of houses and there's not that many people that need houses, but because people can't afford it. The hyper supply is more coming from people can't afford it. We're starting to see more increase in vacancy. We're starting to see lower rental growth rate, moderate to high construction rates, but it's starting to go down a little bit, and lower absorption as well. When the rental markets come onto the market, people can't afford to rent it, or there's just so many options out there that they can't rent it. So whatever that reason might be that causes the hyper supply, but we'll have in the hyper supply that's slowly heading towards the recession, which is the next phase we'll talk about. During that phase, we'll have increase in vacancy, lower construction rates, and also low rental growth as well, with low absorption, because continue to have more supply than demand. whether it's actual need for housing or more of a forced lower need because housing are becoming so much more expensive and we'll have this bad inflation problem. So I know it feels like I'm giving a little economy session, but what I'm trying to say is while it's important to focus on the jockey, it's also important to be aware of what's happening in the economy and when you're making that decisions, because you want to understand based on where you're at in the economy cycle, the specific investment you're making, whether it's in multifamily, short-term rental, mobile home parks, self-storage, how that would play out in the next phase of the project, whether it's for exit or for cash flow purposes, which are two key important returns. Now, the next important part of the market is actually the geographic part. So we want to understand what's happening in that geographic area. So starting from the very broad area, if it's a state, if it's, for example, I live in Fayetteville, Arkansas, is that a landlord-friendly state? Is it going to take a super long time to evict a tenant, or is it going to be pretty fast? What is the population of the market? If a certain company move away, is it going to cause certain jobs to be lost and people moving? If certain companies get shut down, is it going to ruin the whole town's economy and people can afford to pay rent, right? I've seen some of the markets where it's primarily driven by one company. And when the company moves its headquarters, then the whole town shut down and the housing prices start plummeting, right? How's that job growth in that current market? And other more than one employers, like we mentioned, the diversities of the economies. Preferably no more than 20% of the employment of the market depends on that company. And what's the overall median household income for 3, 5, 10-mile radius of the property? That gives you an idea of what kind of tenant profiles you'll have and whether it's for residential or commercial. You want to get an idea of those. Will that be a good fit for the type of property you have? How can you potentially upgrade your properties to fit the needs of those consumers with tenants? And what competitions do you have? How far are they? What conditions they are in? What's the long-term occupancy in the area historically? Are there new projects coming on that may be competing with this property? Can you pull the building permits in the area and see what's happening? And what is the crime rate in the area? Is it concerning? Other natural disasters that are coming in the area you need to be aware of. That could be increasing your insurance costs a lot more than others. That you should also make sure you have a clause in there that covers those specific needs. For example, flood insurance, even though you're not in technically a flood zone, but should you also carry flood insurance? And how does mortgage, and also if it's multifamily, how does the rental rate compare to entry-level house mortgage payment, right? That's also important. For example, in some of the areas you can, and certain time of the economic cycle, you can rent for cheaper than owning a home. Like right now, interest rates are for purchasing a primary home in the 6 and 7% for most people. And it's much more economical for people to just rent. So because of that, it's going to be good for you. But what happens when things changes? So gotta think through those as well.
This podcast is sponsored by Life Mission Capital, founded by me, Micy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
Now, the next piece, while we're kind of staying on the geographic portions a little bit, I want to focus on the next pieces, which is about the due diligence on the physical property. I understand that whether it's your passive investment opportunity or active investment opportunity, you may or may not always have the opportunity to see the property right away. Well, ever, if you're a passive investor, sometimes you just don't really want to make a trip out there. That's the whole point of you investing passively. You're able to see it through maybe somebody else's camera, well, pictures, or someone you know in the area. But some of the crucial factors for you to understand is what is the age of the property. And when I first started investing, I hear people talk about don't invest in anything that's more than 1990s. But that ended up working with some experienced partners, and we took on some properties in like 1960s and 70s. I thought, since we'll have some awesome partners, it shouldn't be a problem. I mean, we never run into a deal breaker problem per se, but with some of this 1960s, 70s properties, or even 80s, some of the plumbing issues, it's just such a pain. And especially once they start having a little bit of the plumbing issue, it's like it never ends. And every so often there's a plumbing issue that pops up that costs money. So what is the age of the property, right? The older the property, it definitely costs more to repair and maintain, especially with some of the infrastructure problems specifically related to plumbing. And also the roof, the flat roof versus sloped roof. So all those are really things to consider. That's going to potentially drive up expenses than the maybe typical percentage that you would be aware of using as a napkin math number. You also want to understand, has the property been renovated? What was renovated and when? How many units in general? And some of the things you would consider when you're a renter as well. For example, how big is it? What's the layout? What's the unit to parking ratio? That can also potentially give, this is a little bit more in details, but as an active investor, you want to know that because it may give you the option to put reserved parking. That's extra income that you can earn. And remember, in commercial real estate, how much you can sell the property solely depends on two factors. One is your net operating income. Two is your cap rate. A lot of times we can't really change the cap rate because that's really determined by the type of property it is and where it sits, and also the overall economic cycle. But we can focus on improving the net operating income. And by having reserved parking, simply adding a few reserved slots by painting numbers on the parking lot sometimes can help you increase your net operating income. And by, let's say, $100,000 improvement in the operating income with a cap rate of 5% gets you $2 million. So that's the amazing part about commercial real estate. So when we're looking at the property, we're looking ways to improve operations by reducing expenses and also improving income. And also getting a realistic expectations about how much it would cost to fix things and also maintaining them. Things like, is there going to be a property management office on site? Do the office need to be upgraded? Will someone be living on site, especially if it's a larger property, but in not so good areas? Sometimes we want to have someone on site to help manage things as well. What's the current vacancy in terms of economic vacancy and physical vacancy, right? Economic vacancy is different from physical vacancy. For physical vacancy, it's essentially where the property is actually vacant. So if we have 365 days in a year this year, and we only rented out 360 days, and there's 5 days we didn't rent it out, we will call those 5 days vacant. So 5 divided by 365 would be our vacancy number. But the economic vacancy is actually different. It's the difference between our building's gross rent potential and the actual rental income. So economic vacancy is the difference between your facility's gross rent potentials and the actual rental income. So to calculate economic vacancy, we need to subtract actual rental income from a gross potential rental income and divide the number by the gross rent potentials. So if your gross rent potential is 50,000, but you're actually only earning 40,000, that means your economic vacancy is 20%. So what is the difference between the gross rent potential and the actual rental income? Some of the things could be happening is that maybe there's a lot of housing available, a lot of new soft storage for multifamily that's being developed in the area. To be competitive, you want to offer a concession. So you discounted rental rates, maybe moving with first month rent for free, for example. Or you may have tenants who are just struggling paying late on rent. And that's also considered economic vacancy. So potential rent you should have received. So there's definitely more questions we also want to cover and get a good idea of. I understand that as you do more of this, more investments, you may not go into all these details on every property. And even your first property probably won't go into all these questions, but I'll give you another little idea on some of the other questions you can ask, but just understand that this is not a complete list. And you don't want to be asking all these questions either. You want to know the answers to most of them, but you don't necessarily have to ask each one of them. Understand that some of the questions may or may not be as important, but it may give you clues about how good this is as an investment. Some of the other things you can ask include, are there cameras covering the properties? Do you have any security systems? How well lit is the property? How is it compared to shopping centers, highways, school district? How good is the school district? Is there access to public transportation? How good is the walkability? All those are important factors you want to consider when you make an investment. But you want to understand what are the most important questions to ask that solves your questions and helps you move the needle in your investment decisions. That will usually vary, and you should always start with the jockey and then the market cycles and the geographic areas, as I mentioned. So hopefully that's helpful. There is a lot more questions, as I mentioned. To learn more about kind of the complete list of questions I have compiled, go to my website, lifemissioncapital.com, ebooks section, and you'll see 110 questions to ask before you passively invest in the commercial real estate passively. So until next time, see you and let your life mission go wild.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Micy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.